Namaskar and welcome to Sansad Television. I am Vishal Dahiya and you're watching our show Perspective, where we bring you detailed analysis of key national and international issues. Today we're going to talk about the interest rate hike by US Federal Reserve Bank. Now, intensifying its fight against high inflation, the United States Federal Reserve has raised its key interest rates by a substantial 3/4 of a point for a third straight time. The US Fed's move on Wednesday boosted its benchmark short-term rate, which affects many consumer and business loans, to a range of 3% to 3.25%, the highest level since early 2008. It also signaled more significant increases in new projections, showing its policy rate rising to 4.40% by the end of this year, before topping out at 4.60% in 2023 to battle the continued strong inflation. In fact, central banks across the world are also hiking rates in an attempt to tackle the issue of inflation. At least 75 central banks have so far lifted their benchmark interest rates in the past 1 year, increasing the price of credit across the world. So we'll try and understand as to what's happening in the global economy and why this string of interest rate hikes by central banks across the world, and what does actually US Fed Reserve's hike means for the economy of United States of America and the global economy as well. And for more on this, we're joined by a distinguished panel of experts. Let me first introduce them to you. Beginning with, we have with us in the studio Mr. Jain Das Gupta. Is the former ambassador to WTO. We're also joined by Mr. A.K. Bhattacharya, Editorial Director of Business Standard. Welcome, both of you gentlemen, to Sansad TV studios. And we're also joined by Professor Charan Singh, CEO of eGrow Foundation, who is with us. Welcome to you as well, Professor Singh. Let me begin with you, Mr. Bhattacharya. And let's start by understanding a bit more about what the US Fed has done, in terms of hiking its rate. One, the rationale, of course, as everybody is saying, to tackle a high rate of inflation. But such strong measures, and that too, if you compare it, looks like the highest level since early 2008.
Certainly, I think you beautifully explained the background and the rationale of it. There is no surprise in what the Fed has done today. Today meaning last evening. And the surprise is not in the 75 basis point increase, but the surprise is on the forward guidance that it is given, that it will be continuing to be on this path of hardening interest rates in the weeks and the months to come.
The policy rate projection.
Absolutely. So I think the earlier, there was a sliver of hope that probably 75 basis point increase will slow down a little bit. The extent of it will come down. Right now there are about 90 central banks have increased their rates, and 50% of them have gone in for 75 basis point increase. Like today, Bank of England has raised it by 50 basis points. So therefore, what is happening globally is a return from the days of easy liquidity, low interest rates, and obviously the 4-decade high inflation rate in the US and similar double-digit inflation in England. Obviously, it's pinching people, pinching policymakers, and reducing the scope for some sort of easy monetary policy completely. Now, this will obviously have an impact on the US market, and it will also have an equally big impact on other economies of the world, particularly the emerging economies. And the global markets, the debt market, the equity markets of all emerging markets, because remember, US is a big investor in all these markets.
Indeed.
So I think it's something that was to be expected, and that's what has happened. But what is a surprise, as I said, is the trajectory of this increase is not going to end, not going to change, reverse direction.
That shows a further cautious approach, which will be followed by the US Fed and perhaps followed by the other central banks there as well. Mr. Das Gupta, your analysis of the situation, wherein there's this continued string of rate hikes by central banks, and now the US Fed, as Mr. Bhattacharya was also pointing out, that it will have an impact. So how do you analyze this?
As far as India is concerned, and many other emerging markets will also be in the same boat, there are four ways in which this will impact us. The first one is that with the US increasing its rate and it coming much closer to the Indian rate, the arbitrage which foreign portfolio investors were getting, especially from the US, by borrowing funds from the US and investing in India in the stock markets, that will not be as attractive. So the second consequence will be that there would be an outflow of foreign currency from India. And people will invest in US equities and in US federal securities. The third consequence will be that with the outflow of funds, there would be a pressure on the currency market. The Indian rupee already has gone above the 80 rupee to the dollar mark today. So that is the third point. The last point on this score is that India, of course, is not as globally integrated as experts have been saying with the world market. So to that extent, there is a bit of a cushion that the Indian economy will not suffer as a consequence of this. So the Indian stock markets will have a bit of a downturn, which is quite visible, but it may not be very, very drastic. So that is the fourth issue.
Okay.
The last point I wanted to mention is that this was very much on the card. So the foreign stock markets, though I think the Nasdaq and the Dow Jones also fell, but they had factored in this 75 basis points reduction. So there has been, I think, more or less stability in the equities market for the moment. But there is a downside to this. The US Fed is going to bring down from 8.3% currently, the inflation rate, to about 2% or below.
Okay.
Now, if it were to keep on doing this in a very aggressive fashion as it has been doing for the past few months, there could be a reduction in wages, there could be a rise in unemployment, and there could be a hard landing for the US economy. It is a tightrope walk. The US Fed is trying to have a soft landing, where there are indications that the US unemployment rate really has not gone up despite the 3 consecutive rises of 75 basis points. So it remains to be seen whether the US Fed's intention of having a soft landing can actually be effected.
Okay.
Despite the rises,
Okay.
the raises of the rate.
Okay, okay, that's a significant point there, and we'll come to the Indian part as well. But Professor Charan Singh, before we come to how it affects our economy, the larger question which people would want to understand and know the answer to is the global economy in continued recession, going by the indications of what the central banks across the world are, tactics they are adopting to tackle inflation. And as Mr. Das Gupta and Mr. Bhattacharya were also referring to that, there are cautious times ahead.
Absolutely, it's a very difficult time ahead. But I must tell you that this is a time which one would have expected long time ago. It is only that the Russia-Ukraine war has accentuated it, and this has precipitated, and then the inflation figures that you see are 4 to 5 times higher than the tolerance levels that are generally visible in these countries, both Europe as well as America. They are used to about 2%, and the inflation is running between 9 to 10%. Of course, it's down to 8.3% now, and of course, with energy prices moderating, and if the war comes to a stop, then probably prices will moderate further. But the biggest issue is, and I've been saying it repeatedly for some time now, look at the way the balance sheet of the American Central Bank as well as Euro as well as Bank of England expanded. Now, 2008, when the Lehman Brothers had not taken place, about $1 million was in the balance sheet. But today, if you look, it is $8 million. It had already risen to $4 million and it stabilized there in 2012. And then now it is $8 million. Means it was so reckless. And I would say if it was India, people would have eaten us up and they would have said the Reserve Bank is irresponsible. Everybody knows, all trained economists know that if you pump in so much money, it is inflationary. And that's exactly that theory, the monetary theory has come out true. If Milton Friedman was alive today, he would be laughing his way. He would say, I have taught you all this 10, 20 years ago and you have not paid any heed to it. So what you are seeing today, both in the US and the Euro area, including Britain, you are seeing playing out of the economic theory. The balance sheets have expanded tremendously. 4 times to 8 times is the expansion in the balance sheet of these central banks. 4 to 8 times is the tolerance, 4 to 8 times is the inflation figure that has exceeded.
Okay.
Now the way they are hitting out at inflation, and I would say this is aggressive, fine, but they have the energy and they have the living standards wherein they can absorb the sacrifice ratio.
Okay.
They will bring down inflation, they will bring down growth. But within the integrated global trade market, countries like emerging countries like India are going to suffer for no fault of theirs. Because there are spillovers going to take place, and as rightly said, about 90 countries have adjusted, and out of that 50 countries are doing it very aggressively. The monetary policy is very, very tight now. Growth is going to get impacted. Employment is going to get impacted. Exports from other countries are going to get impacted. The hard landing is not only for them. The hard landing is for us also.
Everyone.
So therefore I say this irresponsible behavior that the Fed and other countries showed, recklessness both during the post Lehman Brothers and post COVID, and then now, that has resulted in something which is going to impact rest of the world. So what does it really boil down to? Yes, the world is on the brink of recession. We could get into recessionary trends very soon. Slowdown, obviously, we are already in slowdown. And when the spillovers take place and reach the Indian shores and other countries, it is going to be very devastating.
Okay.
So difficult times at least till 2024.
Okay. Difficult times for a few more months there. Mr. Bhattacharya, your views there on 2 aspects. One, as Professor Charan Singh was also referring to, the spillover effect of the global economic situation which we are witnessing right now in terms of tough times, and also how to mitigate this particular situation, how to handle both domestically, which is really important for us, and globally also, because economy, after all, is a cross-border mechanism. It's not a geographical phenomena.
Absolutely. I think from an international perspective, it's very clear that there are no free lunches. If you have done excessive infusion of liquidity into the system, as if there is no tomorrow, you have to pay the price at some point. And I think the global economy is paying the price through its nose. So therefore, once again, Milton Friedman, of course, but even otherwise, it's an ordinary householder philosophy that there are no free lunches at the end of the day. So you have to go through a phase of slowdown, maybe recession also. The US is refusing to call it recession. It may not be. It may be already in a technical recession. But then the fact of the matter is that there will be prices to be paid both in the US as well as in the Europe in terms of overall pace of economic activity. Okay. That is a given thing. Now, what it means for other economies, I will restrict my comment to the Indian economy. I would say there are 2 ways of looking at this, the impact on the Indian economy. One is that recession in the global economy will also mean lowering and reduction in the commodity prices, particularly crude oil. Now, which to my mind is probably good news for an economy like India, which is still dependent on 85% of its needs for imported sources. Now, to that extent, we will be less adversely impacted by what is happening in the world. These, of course, our exports, which were doing well till last year, have already decelerated to a point. There is almost zero growth in the latest last few weeks. Now, that will be impacted, but our import bill will also come down. So therefore, the fears, the biggest fear for India at this point in time was on the external side. To what extent our current account deficit, which is threatening to go beyond 3.5% in the current year from 1.2% last year, is something that I would imagine if there is a commodity price slowdown, Indian external sector will probably be in a better position to tackle the crisis.
Okay, so that's the positive part.
That's the positive part.
But what's the other part?
The other part is that the equity markets in this country will actually go through a prolonged phase of volatility. Now, this volatility will have nothing to do with the fundamentals of the corporate sector, the fundamentals of the economy even, because we are in a way dependent a lot on the foreign flow of money, and that foreign flow of money will go out. But let me also say that what is happening in the globally is also means something that you must look out for in the debt market. Because the debt market is reacting in a different way, where the yields are actually falling and therefore the prices are going up. And the debt market, if you see that there is some sort of a balancing that is happening.
Okay.
So for the savvy investor, it's a mixed news, mixed picture. But for the global economy, it's bad news. And for the Indian economy in a whole, I would say that yes, the impact will be there. But from the external sector, if recession does take place, oil prices do come down, I would say the managing that external sector crisis will be less difficult.
Okay, less difficult or a bit more easier. You know, those are two different phrases. They mean the same, but they sound different as well. Mr. Dasgupta, your views there. You know, how difficult will it be for the Indian economy? You were pointing out earlier certain points, and for the global economy as well, elsewhere in developed countries also, because there is going to be a trickle down effect. Also, what needs to be done? What is it that our policymakers can do? What is it that the policymakers in developed countries should do?
Well, I'll take up the last point which Mr. Bhattacharya mentioned about the impact on the Indian economy. If you look at our exports, there were only about $430 billion in goods and about $220 billion in terms of services. As far as goods is concerned, it has already started slowing down because our two major markets are the US and the European Union. Again, in terms of services, it is basically the US and to a certain extent the European Union and Britain. So our exports will suffer. There is no doubting that. It's already started showing up in goods. It will have its impact on services as well, especially software exports, which is the mainstay of our services exports. US companies, when they face the crunch, they will cut down on their software purchases. So that is going to come. The oil prices will come down, as brought out by Mr. It's already, I think, ruling at around $90 from a high of about $120 a few months ago. So inflationary pressures in India, to that extent, will not be a major concern because we are not import dependent except for crude oil for our consumption requirements. But if we are to expand our economy, we need capital goods. So if there is a pressure on our currency, capital goods will become much dearer than now. So there will be this pressure on investments, and there could be a restrictive influence on investments in new areas, not the kind of software investments and digital technology investments that we have been seeing in the form of unicorns. So that is what I feel is going to be the impact on India. It will be there, but it will not be in terms of its impact. It will not be of very major proportions. As far as the global economy is concerned, we have to look at the countries separately. The US, despite recessionary pressures, and perhaps the figures will show that they are on the way to recession in 2023. But one of the things which has stood out is that their employment figures have not gone down. That is, the unemployment rate has not gone up substantially, despite all this easing, the tightening of the money policy. So that is something which needs to be explained. But if this tight money policy is maintained for some more time, there will be an impact on the employment rates.
Okay.
And what these countries will have to look out for is the poorest sections amongst them, who are covered by Medicare, for instance, in the US, and the national, of course, everybody is covered under the national health scheme. But there would be cuts in education, in health care, and other social sectors.
Okay.
Because the government, for instance, just because of the Ukraine crisis and the increasing oil prices, the UK government stands to borrow about £100 billion till 2023. Now, where will that money come from?
Yeah.
So obviously, it will add to inflationary pressures. They will have to print money or borrow from the market, which will again have its own consequences. So these are some of the things which individual economies will have to face, not the same challenges in, let's say, Germany or the UK or the US or Canada or Japan. But there would be these challenges in combination.
Okay. Okay. So combination of challenges there. Quick final comment from you, Professor Charan Singh, in terms of the areas or sectors where Indian economy is likely to feel the biggest pinch, and also, because of that trickle-down effect, and also mitigating steps. What can be done, or what should be done, rather?
So, the spillovers take place through different channels, through trade, through commodity prices, through sentiments, as well as through capital flows. Now, when there is so much of disruption in the global market, you can imagine all of these get very distorted. When it comes to commodity prices, we really do not know how they are going to play out. Different countries, different demands. When it comes to sentiments, globally, there's going to be recessionary trend. So overall, the recessionary trend in most advanced countries of the world means nearly 60% of GDP is under the recessionary trend. You can very well imagine what is going to happen to the global pattern of trade and global pattern of commodity prices as well as capital flows.
Okay.
Now, what is going to happen? Inflation in India, thanks to the government and the RBI, their excellent policies, we are on the upper fringe of the band. So we are not 4 to 5 times. Thanks to them, we are under control. The fiscal deficit, reasonably under control. We have already declared openly what our fiscal deficit is. Current account deficit is totally under control. So India is not at risk. But what is going to happen? The corporate sector could come under stress. The remittances which we used to get from abroad, they could come under stress. IT already mentioned, exports could be under stress. Tourism could be under stress. Okay. So what can the Reserve Bank do or Government of India do, and what should the rest of the world emerging countries do? To my mind, my own feeling is once the war is over, the high price rise which is being witnessed now will be under control. I think the advanced countries need to sober down and not do such an aggressive thing. England today has just increased the rate by 25 basis points. I think that's the way to do it. The way they were doing expansion of balance sheet, too aggressive. Now the way they are reacting too aggressive is very disruptive for the global market. So I think once the inflation pressures come down, they have to sober down, and the aggressive part should go. Everybody understands inflation is high. It has to be understood that these advanced countries have a global responsibility. When they do aggressive policies, they can withstand sacrifice ratio. Countries like India and other emerging countries cannot. So that's another reason that social responsibility, global responsibility will demand on them. As far as India and the Government of India are concerned, I think they have done reasonably well, but they may have to extend the food support that they have done earlier till October. They may have to extend it. The Reserve Bank of India will have to perforce match, not exactly, but to some extent has to be raising the interest rates, which I think they will have to do. When it comes to the balance sheets of the commercial banks, I think the Reserve Bank will have to be more accommodative and kind. Same thing will happen with the non-banking finance companies. the banks will also have to be a little more careful and I think little benevolent and kind in extending to the corporate sector as well as the export sector, because that's where the pressure is going to be.
Okay.
As far as other emerging countries are concerned, I think they'll have to be very watchful. The last point I want to make is this is the time for the multilateral institutions like the World Bank, like the IMF to come, and they have to get all these countries together. There's a meeting coming up at the IMF in Washington in October. I think they have to put their heads down together and say how to stave off the recession which can engulf the whole world for next 2 years. Reviving growth is not easy. For 2 years, if you're in a recession period,
Indeed.
production mechanics change, people retire, people lose their skills. So therefore, it's important that while Americans are trying to reduce their unemployment, we in other countries have to ensure that our employment is sustainable. Therefore, the multilateral agencies like the IMF and the World Bank will have to play a crucial role. They may have also to support and gather financial resources so that these emerging countries at least have a soft landing blow from these advanced countries. I would also think that the advanced countries will also have to extend a hand to the emerging countries so that the blow is not felt equally hard. The last thing I would like to mention is that the ammunition and defense industry globally has to play a more responsible role. Russia will have to probably be told this is not the time and they will have to go slow, because Russia is also getting very aggressive. The geopolitics has spilled into the economic implications, which has spilled into the now recessionary thing. So I think the whole globe will have to put their head down together. United Nations and multilateral institutions will have a very important role to play going forward.
Indeed. There will be an important role to play for them. Thank you so much, Professor Charan Singh, Mr. Bhattacharya, and Mr. Dasgupta as well for sharing your views and insight. As our experts were pointing out, of course, there are tough times ahead, cautious approach needed, and that is what seemingly is evident in the moves made by central banks across the world, specifically the US Federal Reserve, which has once again raised the interest rates. As far as emerging economies or developing countries like India is concerned, there is likely to be a spillover effect, but there are mitigating steps which can be taken to absorb that impact and move ahead. We'll keep you updated on all these developments and bring you more topics as well. Till then, keep watching Sansad Television. Thank you.